Hey everyone, let's dive right into this brand new explainer where we are going to decode a massive accounting mystery, the corporate freebie. You know the drill, right? A customer places a huge order and the supplier sweetens the pot with a gold coin or even a fully paid luxury tour. Sounds like an absolute marketing win. But behind the scenes, well, it creates a fascinating puzzle for accountants and auditors. Today, we're unpacking exactly how Indian Accounting Standard 115 tackles these tricky customer incentives.
Welcome to a brand new video right here on the Gap Advisors Ind AS Clinic YouTube channel. So glad you've tuned in. Now, just a quick heads up before we really get into the weeds. The views I'm expressing today are entirely my personal views and they aren't binding. You always want to seek the help of an expert before taking or refraining from any action based on what we talk about here today. All right, to set the stage, let's quickly lay down our ground rules for this scenario. We're assuming the functional currency and the presentation currency is the Indian rupee. Any currency other than the functional currency, that's a foreign currency. And of course, our financial clock follows the standard Indian financial year. So the reporting period begins on the 1st of April and ends on the 31st of March.
Okay, here is a quick look at our roadmap. We've got 1. The incentive dilemma, 2. Identifying obligations, 3. Pricing variable incentives, 4. The journal entries, 5. The investor angle, and 6. Connect with Gap Advisors. Let's get to it.
The incentive dilemma.
So let's set up a scenario that is literally a dream for a sales team, but honestly kind of terrifying for accounting. Imagine a company promising its customers a gold coin, or even a fully paid foreign or domestic tour if they hit a specific revenue target. As a customer, you're absolutely thrilled, but as an accountant, you're looking at this and thinking, how on earth do I put an unclaimed luxury vacation on a balance sheet? When exactly do we recognize the revenue for these schemes? You can't just pretend the promise doesn't exist, but you haven't actually delivered that vacation yet either.
Section 2. Identifying obligations.
To solve this, we bring in Ind AS 115. It gives us a really solid 5-step model for recognizing revenue. Step 1, identify the contract. Step 2, identify the performance obligations. Step 3, determine the transaction price. Step 4, allocate that price. And Step 5, recognize the revenue when those obligations are satisfied. Now, Step 1 is a breeze here. The contract is the sale of goods plus that incentive of gold or tours. But Step 2, that is where the real detective work kicks in.
Here's the key realization, that single contract is actually making 3 entirely separate promises to the customer. Under paragraph 22 of Ind AS 115, we've got to break down each promise to transfer a distinct good or service into its own separate performance obligation. So we have 1, the primary sale of goods, 2, the supply of the gold coin, and 3, the tour service. But we have to ask, are they legally distinct?
Well, paragraph 27 says a good or service is distinct if it hits 2 criteria. First, can the customer benefit from it on its own? Obviously, yes. You can totally enjoy a gold coin or a trip to Switzerland without the primary goods you bought. Second, is the promise distinct within the context of the contract itself? Paragraph 29 clarifies this by asking if the items are highly integrated or significantly modified by each other. Nope, the sale of goods isn't intertwined with the vacation. So since there's no transformative relationship there, they are absolutely separate, distinct performance obligations.
Section 3. Pricing variable incentives.
Now we hit a really unique challenge. How do you price a reward that a customer might not even claim? Because people forget, or maybe they just miss that final sales target. That makes the consideration in our contract variable. Paragraph 50 of Ind AS 115 tells us we actually have to estimate this amount. We use what's called the expected value method. It's honestly a lot like predicting the weather based on historical data. If past data shows only 60% of customers actually pack their bags and take that foreign tour, the company uses that probability to estimate the transaction price. No internal data? Then you look at industry peer data for a representative sample. And this donut chart beautifully shows how we handle Step 4, allocating that transaction price. Under paragraph 74, we allocate the total estimated price to each performance obligation based strictly on their relative standalone selling prices. It's super logical. You just ask, what would we sell these primary goods for by themselves? What's the market value of that gold coin? What's the retail price of the tour? You take those standalone prices and slice up the total transaction pie proportionally.
Section 4. The journal entries.
All right, let's slow down a sec because this is the big reveal where the CA students, auditors, and finance teams are going to want to take some notes. When that initial sale happens, how is it recorded? Well, we debit the customer account for the total amount. Then we credit revenue from sale of goods. But wait, only for the specific portion of the price we just allocated to the goods. You absolutely cannot recognize the portion for the golden tours as revenue yet because you haven't fulfilled those promises. Instead, that chunk gets parked safely on the balance sheet as a contract liability. It's literally unearned revenue just waiting in the wings.
So what's the follow-up? If the customer crushes their target and claims the reward, we debit that contract liability and finally credit revenue from sale of goods or tours. But what if the whole claim period lapses? The customer forgets about their freebie. Well, we still debit the contract liability to clear it, but this time we credit revenue from sale of goods. Why? Because the company gets to keep that value without ever having to shell out for the incentive. Seamlessly, the liability transforms into recognized revenue right when the standard says it should.
Section 5. The investor angle. Now, why should someone investing their hard-earned money in the shares of listed companies even care about Ind AS 115? Here's the deal. If a company completely ignores these rules, books all that revenue up front, and just conveniently forgets to record a contract liability for those gold coins and luxury vacations, their current profits are going to look totally artificially inflated. They'll look like financial superstars today while hiding huge future costs. So, understanding how these accounting standards treat variable consideration, that's your ultimate shield against financial illusions. It's how you uncover the true financial health of a company.
Section 6. Connect with GAAP advisors.
Okay, we've decoded the mystery, and now I want to hand you the keys to the kingdom. This specific issue and the detailed response we just walked through comes straight from the incredible issue repository on gapadvisors.com. This platform is a goldmine with over 4,500 issues and responses on Indian accounting standards and Indian GAAP. Anyone can register for free, submit your own issues, and get a detailed response delivered directly to your inbox. This is an absolute game changer, especially for auditors who need to rigorously document how they addressed Ind AS applications. Plus, today's topic was actually featured in the 212th edition of the GAAP Advisors Task Weekly newsletter, written by CA Manish C. Iyer. There are over 230 editions on LinkedIn right now, so definitely go subscribe for free. And hey, if you need one-on-one help, you can even book a consultation directly with the author on topmate.io.
And listen, the learning does not stop here. If you want a really deep auditory dive into the exact nuances we tackled in this video, you have to check out the GAAP Advisors Ind AS Clinic podcast. You can pull it up right now on Spotify, Amazon, or right here on YouTube. It is literally the perfect companion for your morning commute.
And that wraps up our explainer for today. Thank you so much for hanging out and giving me your time. If you found this breakdown valuable, please hit that like button, drop your thoughts or questions in the comments, and subscribe to the GAAP Advisors Ind AS Clinic channel if you aren't already. And one huge favor, please share this video among your contacts, colleagues, audit and finance teams, and all those students currently pursuing their CA course. Let's work together to spread the knowledge of Indian accounting standards. Keep questioning those numbers and ask yourself, if a simple freebie can fundamentally alter a balance sheet, what other financial illusions are hiding right in plain sight in the annual reports you read?